Hi all, welcome back to FinaLit YouTube channel. This is the part 3 of our technical analysis video series. Today we are going to discuss about Japanese candlestick chart patterns such as single candlestick patterns as well as multiple candlestick patterns. There are two types of candlesticks, bullish candle and bearish candle. The structure of the candlestick, however, remains the same. When closing price is greater than opening price, it is a bullish candle. When closing price is less than opening price, it is a bearish candle. Time frames play a very crucial role in defining the trading success. It should choose very carefully. The number of candle increases when the frequency increases. The candlesticks are used to identify trading patterns. Patterns help the technical analyst to set up a trade. The patterns are formed by grouping two or more candles in a certain sequence. Sometimes, powerful trading signals can be identified by just a single candlestick pattern. Therefore, candlesticks can be classified into two, such as single candlestick pattern and multiple candlestick patterns. Single candlestick pattern. As the name suggests, a single candlestick pattern is formed by just one candle. The trading signal is generated based on one day's trading action. The length signifies the range for the day. In general, the longer the candle, the more intense is the buying or selling activity. If the candles are short, it can be concluded that the trading action was subdued. The trades have to be qualified based on the length of the candle as well. It should avoid trading based on subdued short candles. Types of single candlestick patterns: Marubozu, bullish and bearish, spinning tops, Doji, paper umbrella, hammer and hanging man, shooting star. Marubozu. The word Marubozu means ball in Japanese. There are two types of Marubozu, the bullish Marubozu and the bearish Marubozu. The blue represents the bullish Marubozu and the red candle represents the bearish Marubozu. The absence of the upper and lower shadow in a bullish Marubozu implies that the low price is equal to the opening price and the high price is equal to the closing price. Hence, whenever open equal to low and high equal to close, a bullish Marubozu is formed. A bullish Marubozu indicates that there is so much buying interest in the stock. Buy around the closing price of a bullish Marubozu. Keep low price of the Marubozu as a stop loss. Bearish Marubozu indicates extreme bearishness. Here the open is equal to the high and close is equal to low price. Open equal to high and close equal to low. A bearish Marubozu indicates that there is so much selling pressure in the stock. Sell around the closing price of a bearish Marubozu. Keep the high of the Marubozu as the stop loss. A Marubozu can appear anywhere in the chart, irrespective of the prior trend. The trading implication remains the same. Spinning top. A spinning top has a small real body. The upper and lower shadows are almost equal in length. Open and close prices are very close to each other. It conveys indecision in the market, with both bulls and bears being in equal control. The color of the spinning top doesn't matter. What matters is the open and close prices are very close to each other. Unlike the Marubozu, it doesn't give the trader a trading signal with specific entry or an exit point. However, the spinning top gives out useful information with regard to the current situation in the market. The trader can use this information to position himself in the market. Spinning top at the top end of the rally indicates that either the bulls are taking a pause before they can resume the uptrend further, or the bears are preparing to break the trend. Spinning top at the bottom end of the rally indicates that either the bears are taking a pause before they can resume the downtrend further, or the bulls are preparing to break the trend and take the markets higher. Either case, the trader's stance has to be cautious. If the trader's intent is to buy, he is better to buy only half of the quantity, and he should wait for the markets to make a move. Doji. It doesn't have a real body at all. This means the open and close prices are equal. Dojis provide crucial information about the market sentiment. A trader's stance based on dojis is similar to stand taken when a spinning top occurs. Paper umbrella. A paper umbrella consists of two trend reversal patterns, namely the hammer and the hanging man. A paper umbrella has a long lower shadow and a small real body. Upper shadow will be very small or even no upper shadow. The lower shadow and the real body should maintain the shadow to real body ratio. The length of the lower shadow should be at least twice the length of the real body. The open and close prices are close to each other. The hammer pattern is bullish and hanging pattern is relatively bearish. Appears at the bottom end of a downtrend rally. It is called the hammer. Appears at the top end of the uptrend rally. It is called as hanging man. The hammer is a bullish pattern, and one should look at buying opportunities when it appears. The low price of the hammer acts as the stop loss price trade. The hanging man is a bearish pattern. which appears at the top end of the trend. One should look at selling opportunities when it appears. The high of the hanging man acts as a stop loss price for the trade. Shooting star. Unlike a paper umbrella, the shooting star does not have a long lower shadow. Instead, it has a long upper shadow where the length of the shadow is at least twice the length of the real body. The color of the body doesn't matter. The shooting star is a bearish pattern which appears at the top end of the trend. One should look at shorting opportunities when a shooting star appears. The high price of the shooting star will be the stop loss price for the trade. The shooting star is a bearish pattern. Hence, the prior trend should be bullish. The price action on the shooting star is quite powerful, thus making the shooting star a very popular candlestick pattern to trade. The stock is an uptrend implying that the bulls are in absolute control. When bulls are in control, the stock or the market trends to make a new high and higher low prices. Types of multiple candlestick patterns. Engulfing pattern, bullish and bearish. Harami, bullish and bearish. Piercing pattern, dark cloud cover, morning star, evening star. Engulfing pattern. Multiple candlestick patterns evolve over 2 or more trading days. The bullish engulfing pattern evolves over 2 trading days. It appears at the bottom end of downtrend. Day 1 is called P1 and day 2 is called P2. In a bullish engulfing pattern, P1 is a red candle and P2 is a blue candle. P2's blue candle completely engulfs P1's red candle. A risk taker initiates a long trade at the close of P2 after ensuring P1 and P2 together form a bullish engulfing pattern. A risk-averse trader will initiate the trade the day after P2 near the close of the day. The stop loss for the bullish engulfing pattern is the lowest low between P1 and P2. The bearish engulfing pattern appears at the top end of an uptrend. P1's blue candle is completely engulfed by P2's red candle. A risk taker initiates a short trade at the close of P2 after ensuring P1 and P2 together form a bearish engulfing pattern. The risk-averse trader will initiate the trade the day after P2. After confirming, the day forms a red candle. The highest high of P1 and P2 forms the stop loss for a bearish engulfing pattern. Piercing pattern. The piercing pattern was very similar to bullish engulfing pattern, except that P2's blue candle engulfs at least 50% and below 100% of P1's red candle. Dark cloud cover. The dark cloud cover works similar to the bearish engulfing pattern, except that P2's red candle engulfs at least 50% and below 100% of P1's blue candle. The trade setup is exactly the same as the bearish engulfing pattern. Think about the dark cloud cover as the inverse of a piercing pattern. Harami. Before you get thinking, the word Harami doesn't stand for the word Harami used in Hindi. Apparently, it is own Japanese word for the meaning of pregnant. You would appreciate the intuitiveness of this word when you see the candlestick formation. Harami is a two-candle pattern. The first candle is usually long and the second candle has a small body. The second candle is generally opposite in color to the first candle. On the appearance of the Harami pattern, a trend reversal is possible. There are two types of Harami patterns, the Bullish Harami and the Bearish Harami. A Bullish Harami candle pattern is formed at the lower end of a downtrend. P1 is a long red candle and P2 is a small blue candle. The idea is to initiate a long trade near the close of P2 risk taker. A risk-averse trader will initiate the long trade near the close of the day after P2 only after ensuring it forms a blue candle day. The stop loss of a bullish Harami pattern is the lowest low price between P1 and P2. The bearish Harami pattern is formed at the top end of an uptrend. P1 is a long blue candle and P2 is a small red candle. The idea is to initiate a short trade near the close of P2, risk taker. The risk averse will initiate the short near the close of the day only after ensuring it is a red candle day. The stop loss on a bearish Harami pattern is the highest high price between P1 and P2. Morning star. Star formation occurs over 3 trading sessions. The candle of P2 is usually a doji or a spinning top. If there is a doji on P2 in a star pattern, it is called a doji star. Morning doji star, evening doji star. Else, it is just called the star pattern like morning star or evening star. To validate the formation of morning star on P3, the following conditions should satisfy. P1 should be a red candle. With a gap down opening, P2 should be either a doji or a spinning top. P3 opening should be a gap up plus the current market price at 3:20 p.m. should be higher than the opening of P1. Morning star is a bullish pattern which occurs at the bottom end of a trend. The idea is to go long on P3 with the lowest low of the pattern being the stop loss or the trade. Evening star. Evening star is a bearish pattern which occurs at the top and then uptrend. The idea is to go short on P3 with the highest high of the pattern acting as a stop loss. The star formation evolves over a 3-day period. Hence, both the risk aware and risk taker are advised to initiate the trade on P3. Thank you for watching.